All right, welcome to another episode of Asset Coach and Tax Strategist, and excited you're here. Hey, if you're a subscriber, thanks so much for joining us again. If you're not a subscriber yet, please subscribe. We drop episodes every Thursday. Give us a thumbs up for our content. If you don't like our content, that's okay. Give us a thumbs up just so we know that I'm just kidding. So here's the thing. So the goal for us is to give you information to be able to build wealth, but also reduce tax liability. Okay. And as an asset coach and tax strategist, the way to do it is by understanding your assets. So in previous episode, we went through balance sheet, income statement or a profit and loss statement, and the statement of cash flows. And I showed you two examples. But as an asset coach and tax strategist, what we want to do is look at assets, know what an asset is. And in order to know an asset, you need to know the balance of that as a liability, right? And so today's episode, we're going to go through that. We're going to dive into that a little bit and go through now. Other episodes, we'll dive into specific types of assets, how the rules of that assets work, why that asset may be good or bad for you. Now, keep in mind, I'm not giving you financial advice. I'm not giving you tax advice. I'm not giving you legal advice. This is for information purposes only. This is YouTube. I don't know you. You don't know me. Well, you probably know me more than I know you. And so keep in mind that this is to give you content that builds your education as a business owner and understanding of what's important, valuable to grow wealth. But you cannot grow wealth without reducing taxes. They're bosom buddies, fraternal twins. They're a parallel pathway. Okay, they are different, but you cannot have one without the other. In fact, you can't save money on taxes without wealth. The more assets, the more income you have, the more access to the tax code you have. That's with the old adage, the wealthy get wealthier. Yeah, because they have more. And so they have more access to more of the tax code. Therefore, the less you have, the less you have access to. Okay, just very, very simple. So what is a asset? This is key. So let me share my screen here. We'll go through again. Where are we getting this stuff from? Investopedia. And we'll put this in the description right down here, the link right here. So you can just click on this link and go right to their site. Again, I'm using public information you have access to. Okay. This is the team that updated, the people that I've contributed. So if you want more information, go Google it, darn it. But that's why you're coming to us. So we'll Google for you and give you the cheat notes, so to speak. Okay. So what is an asset? It's a resource with an economic value. That's important. It's a resource with economic value for an individual or a corporation or a country. This is important. The United States has assets, and I'm going to share with you the most important asset of the United States is its citizens, also known as taxpayers. You are their cash machine. You're their ATM machine. When they're printing money, they're thinking of your tax revenue of the money they're printing. Okay, so assets are reported on the balance sheet, like we talked about in previous episode. They're bought or created to increase a firm's value or benefit. Okay, they bring value or benefit. An asset is something that may generate cash flow, reduce expenses, or improve sales. Okay, so what's that mean? Well, yeah, it may generate cash flow. It may reduce expenses because of the value of it, what it's bringing to you, but improve sales. Okay, that's important. What's an asset? Marketing assets. Salespeople are assets. Okay, so assets can be classified as current, fixed, financial, or intangible. All right, now we can go through and talk about each of these and all this kind of fun stuff, and current assets being cash and fixed assets and being more equipment and buildings, like it says here. But we're probably going to dive into that more when we dive into these types of assets more specifically. But you need to understand an asset. And so let me use Robert Kiyosaki's basic description of what an asset is. I love it. It's simple, it's to the point and clear. An asset is something that appreciates in value and creates income. Done. When it creates income depends on the asset. For example, you as an individual, you work for a company or you're an owner of your own company and you generate an income personally. How do you do that? Well, that's a W-2. It's wages. And so it's taxed as wages. But that's because of you involved in the business generating that, right? Well, what if it is a stock or a property or business, something you purchased and it generated value, didn't generate cash flow, you didn't get any income from it today, but it appreciated and grew, and then you sold it. And what you paid for it, your cost basis or your principal contribution, and the value of what it sold, that gap, that difference is what? Profit. Equity, you can call it. That is capital gains. So when you sell that asset, though it may not have created cash flow, it creates income as form of capital gain. And based on your situation, tax situation, it's either 15 or 20% tax on that. Okay, pretty great. So we'll dive into assets and different types of assets and all that fun stuff, but very, very important. Okay, very, very important to understand that. Types of income is important. So we'll have another episode talking about types of income. What income do you want? What do you not want? Okay. So there are non-physical assets. So we need to understand what those are. This is very important for our business owners. Okay. Any type of intellectual property, contractual obligation, any royalties or goodwill are non-physical, intangible assets. This is so important. I see so many businesses not protecting this part. So like what we do, the first thing we do is try to trademark something that we're doing. Okay, so we can protect its name, protect its what we're building out from it. So whether it's a service mark or a trademark, okay, we have some clients that have created things that we really need to go in and dive in to protect it. Also, setting up another entity. This is another thing with assets. What's the risk of that asset? Should it be a separate entity within the overall entity because there's a certain liability or risk to that? So that leads us to the next conversation is liability. What is a liability? So it's if there's balance in the universe, right? Left, right, up, down, front, back, asset, liability. Okay. So what is a liability? Generally speaking, something that you owe somebody. Or an entity could be considered a somebody. It's a legal or regulatory risk or an obligation. I think the best terms are owe, something you owe, and an obligation to pay that back, right? Companies book liabilities on opposite, so balance, right? Of assets. There's current liability, so short-term obligations, usually within a 12-month period. Okay, so like credit cards typically are a short-term liability or current liability. Long-term are any obligations that are longer than a year. So if you have a finance agreement on equipment or a mortgage or you own the building, but it's the bank is holding the note. Okay, that would be long-term. Promissory notes. If you have investors that you've set up a promissory note instead of giving shares and ownership, that also is a long-term liability. So the key here is that now there's a lot of times you'll work with certain types of people like Dave Ramsey, Susie Orman. One thing to keep in mind, they're talking to the masses. Okay, you're unique as a business owner, and therefore you should have unique advice. Debt, liability is not always bad, especially if that debt or liability is helping you to increase assets. Okay, you got to understand the terms of the debt and where you're getting the debt and how it's structured. But as a business owner, the only way cash can move and flow is utilizing debt. Okay, the entire world economy is based off of that word debt. Money is not created until it's borrowed or lent. Okay, very important to understand. And this is something that I had to come to the realization over my years of experience, because reading so much, yeah, I've read Dave Ramsey, I've read Susie Orman, right? I've read a lot of these people, but then I realized, okay, they're talking to the masses. They used to have securities licenses. They got rid of them so they can say whatever they want and talk to the masses. So I'm not saying what they say and preach is wrong. What I'm saying is, as a core, it's important to understand why you're doing something. That's the planning. So, but as a business owner, which is why it's important to understand your financial statements and your flow of cash, it's also important to understand how to utilize debt and liabilities to increase those assets. Okay. So, and it's capital. That's what it comes down to, the need and use of capital. In a personal lifestyle, debt and capital, borrowing it is very expensive. Okay. And it's not to your advantage. Okay. Give you an example. You have a credit card, and when you applied for that credit card, your credit card company said, we approve you for $20,000. You're like, yes. Right. And then you go use it. And then there's an interest rate. So after the introductory interest rate, you all of a sudden are charged an interest. And let's say it's 9%. Okay. Now the economic interest rates go up. So you still have, let's say, $5,000 of debt on that card. You're paying 9%, but interest rates go up. What happens? Your 9% now goes to 9.75. What changed? The interest rates, not your debt load, not you, right? But now let's say you start using that card more and you reach the 50%. So you approved for 20,000 in credit, you have 10,000. What happens to the interest rate? It'll go up. And the more you use and the closer you get to that 20,000 credit limit, your interest rate continues to go up. Why? Because now the risk is becoming greater to the credit card company. And because the risk is becoming greater, they're charging you for that risk in the form of interest rate. But time out. They said I was approved for 20,000. Why can't I use it? You can use it. But in return, the interest rate will go up because their risk is higher. So they're going to get a return on that risk. Okay. So that's important. So that's where Dave Ramsey and Susie Orman and those folks are talking about, whoa, time out, personal. That they're right. Now, in a business, same scenario. I actually, my 20,000 in credit line, the more I use, the credit card company will say, hey, Bob, you know what? We just bumped you up to 30,000. I didn't reapply for it, but because my payment, I paid, I kept it down, I was organized, right? I used it. What they wanted to do is they'll give me more debt. Why? Because it's capital to build more revenue in a business. Okay. It's a different mindset, different rules. Okay. So it's very important to understand that as you're going through this, understanding assets and liability in your financial statements, is how to build wealth and which asset to use and how to use debt, liability with assets to create more assets, to actually also create more tax reduction and reduce your risk in liability as well, which is mind-blowing. You're like, how's that possible? Great. Stay tuned to other episodes as we continue to expand. So, asset, something that appreciates and grows in value and can create income. Okay, awesome. That's what I want. Liability, something you owe, it's or an obligation. Now, the terms of the obligation, the note or the financing, the terms make the deal. Okay, so you need to understand that. That's the balancing. It's the scale. Okay, what am I doing? How are we doing it? How and why are we doing it? Okay, very, very, very important. Okay, so think about that. Jot down your comments down below. Love to hear them. Give us a thumbs up. Subscribe if you haven't subscribed, and we'll see you in the next episode. Thanks so much, guys. Have a blessed day.